Imagine this. You've got the U.S. government using cryptographic networks to literally freeze millions of dollars of adversary assets.
Right. Which is a huge move on its own.
Yeah, exactly. But then, in the exact same week, a physical U.S. cash blockade forces those exact same adversaries to migrate onto crypto networks just to survive.
It's just a wild contradiction.
It really is. I mean, we are watching the real-time weaponization of both physical fiat and digital ledgers. So welcome to the week that was.
Glad to be here.
Today, we are serving as your guides to untangle, well, just a massive week of macroeconomic shifts, geopolitical friction, and structural changes in digital assets.
Yeah, and the mission here for you listening is really to understand how kinetic military actions and all of the central bank drama are directly rewriting the architecture of the global market.
Right. So where do we even begin with all this?
Well, I think it's a critical moment to establish an analytical baseline, because currently the market is caught in this really violent tug of war.
Okay, pulling in which directions?
So pulling on one end, you have the persistent inflationary pressure of global energy shocks. But pulling on the other, you have the deflationary signals of a cooling domestic labor market.
Ah, right.
And if you want to understand how that tension is resolving, we really have to look at Bitcoin, which is currently acting as the primary gauge for this systemic stress.
But, before we even glance at a market chart, we have to look at the physical world disruptions that are driving all this capital movement.
Definitely. The physical catalysts are everything right now.
Yeah, I mean, we are talking about the Gulf of Oman, which just saw a massive escalation by the U.S. military. And this wasn't some strongly worded diplomatic cable.
No, not at all.
The U.S. escalated its naval blockade, and it got incredibly kinetic.
Yeah, the event that risk models immediately began pricing in was the interception of the commercial vessel MV Tuska. And this was done by the USS Spruance.
Right.
And to understand the scale here, the Tuska is a 294-meter, 5,000 container ship.
It's massive, and I'm looking at the timeline of this seizure, and it's just intense. The Naval Command broadcast warnings to the ship for 6 solid hours.
6 hours of warnings, yeah.
And when the vessel refused to comply or change course, the USS Spruance actually fired its 5-inch Mark 45 naval gun directly into the commercial ship's engine room.
They essentially blew a surgical hole into the propulsion system.
Yeah, just to paralyze this massive cargo ship in international waters.
Well, they utilized targeted disabling fire because the ship was flagged for illicitly procuring sodium perchlorate.
Which is what exactly?
It's a key oxidizer used in solid rocket propellants. So once the vessel was dead in the water, U.S. Marines deployed via helicopters to execute a hostile boarding.
Ow.
And the geopolitical fallout from that specific action was instantaneous.
Oh, yeah. It completely imploded the Islamabad peace summit. The Iranian delegation walked out, withdrew entirely, and then they activated air defense systems over Tehran to intercept incoming microdrones.
Right. The escalation was immediate.
We did see a separate 3-week ceasefire extension secured between Israel and Lebanon. But the Strait of Hormuz itself is now just a paralyzed, heavily militarized zone.
Which introduces the economic reality of this military action. I mean, the Strait of Hormuz handles a massive percentage of the world's petroleum.
Right, the carotid artery of the global economy.
Exactly.
Right.
When you restrict that choke point, maritime insurance underwriters instantly reprice the risk of moving energy. And that caused Brent crude oil futures to violently spike past $100 a barrel.
See, I'm looking at the ship seizure, and I get why oil goes up, a supply chain gets cut off, energy gets expensive.
Sure.
What I don't get is how a ship getting disabled by a naval gun in the Gulf of Oman triggers an algorithmic buy order for Bitcoin or, like, sovereign debt in New York 3 seconds later.
They're not connected.
So connect those dots for me. How does the physical water connect to the digital order book?
Right, so if we connect this to the bigger picture, energy is the foundational input cost for literally everything else in the global economy.
Oh.
If oil sits above $100 a barrel, factories pay more for power, logistics companies pay more for fuel, and all of that is passed to the consumer.
Right, so everything gets more expensive.
Exactly. That is persistent supply-side inflation. And that specific type of inflation ties the hands of central banks. It makes it nearly impossible for the Federal Reserve to cut interest rates.
And maintaining high interest rates suppresses the value of non-yielding assets, right?
Yes, because investors can just park their cash in government bonds and earn a risk-free return.
Okay, so that structural reality brings us right to the doorstep of the Federal Reserve. And they're trying to navigate this energy shock while dealing with a massive leadership transition and some truly bizarre political gridlock.
Yeah, the timing couldn't be more complex.
Because they're looking at completely contradictory data. On one side, there is the $100 oil you just mentioned driving inflation up.
Right.
But on the other side, the domestic U.S. data shows the labor market is actually cooling down. Like, initial jobless claims recently rose by 6,000, bringing the total to 214,000.
And that is the core dilemma for any central bank. A cooling labor market usually signals a desperate need to cut rates, to make borrowing cheaper so companies can hire.
But they can't do that.
Right, because that creates an agonizing conflict with the energy inflation data, which demands rates stay high to cool down prices.
Catch-22.
Exactly. And stepping directly into the middle of this impossible balancing act is the Fed chair nominee, Kevin Warsh.
Oh man, Warsh. He just submitted his written testimony to the Senate Banking Committee, and he completely threw out the traditional central bank playbook.
You really did.
He vehemently defended central bank independence from executive interference, but he also explicitly stated he wants, and I'm quoting here, messier committee meetings.
Yeah, he actually wants to reduce forward guidance predictability.
Which is wild.
It is. He's deliberately telling the bond markets to stop relying on the Federal Reserve to telegraph every rate hike or cut months in advance.
Right. He wants the market to react to the data, not to the Fed's handholding.
Precisely.
Mm-hmm.
But, his monetary philosophy was almost entirely overshadowed by his financial disclosures.
Okay, this is where the story gets absolutely wild. Warsh's disclosures revealed an investment portfolio exceeding $100 million.
Yeah, a massive portfolio.
And it is heavily concentrated in AI compute infrastructure and digital assets. I mean, we are talking about direct stakes in Solana, the DYDX protocol, Bitwise funds.
He has committed to divesting these assets before taking office, though.
Right, but I have to push back here. Is this a massive conflict of interest for the guy basically running the money printer, or is this just what a modernized, diversified portfolio looks like at the institutional level today?
Well, I think it serves as a profound reflection of how deeply integrated these technological assets are within modern institutional wealth.
Okay.
Even with a full divestiture, Warsh's prior investments signal something the market just hasn't seen before.
Which is what?
A structural foundation of understanding and support for decentralized architecture at the absolute highest levels of the U.S. financial system. I mean, he actually understands the mechanics of the assets he will be indirectly regulating.
That makes a lot of sense. But his path to actually taking that seat was completely blockaded until just a few days ago.
The political drama was intense.
Yeah. Senator Tom Tillis had placed a legislative hold on Warsh's confirmation, and it wasn't even about Warsh.
No, it was entirely leverage.
Tillis was using the confirmation as leverage over an ongoing Department of Justice criminal probe into the current chair, Jerome Powell. The DOJ was investigating cost overruns on a $2.5 billion headquarters renovation.
And that political blockade was injecting a massive amount of anxiety into the markets. Markets can handle bad news,
Right, they just price it in.
Exactly. But they despise uncertainty, especially a leadership vacuum at the world's most powerful central bank.
But then, out of nowhere, the DOJ unexpectedly dropped the criminal probe entirely. They transferred the oversight to the Inspector General instead.
Which changed everything overnight.
Right, that satisfied Tillis's demands, the blockade was lifted, and the path for Warsh is suddenly totally clear.
And the immediate market reaction to that probe being dropped was the removal of a massive uncertainty premium from sovereign debt markets.
Because they finally knew who was going to be in charge.
Yes. With Warsh's path cleared, algorithmic trading models could finally price in his specific, data-dependent monetary stance rather than just pricing in pure political chaos.
Okay, wait. So if Warsh is explicitly promising a messier, more unpredictable Federal Reserve, and we have $100 oil threatening to keep inflation high, traditional financial models dictate that risk assets should be terrified.
They absolutely should be.
So why did we see digital assets suddenly surge instead?
Well, because the market mechanics underneath those digital assets had become dangerously lopsided.
How so?
It created a scenario where any positive news, like the resolution of the Fed gridlock, would act as a spark in a powder keg.
Okay, let's break down that powder keg because we saw Bitcoin decisively break out of a multi-month consolidation range that was stuck between 62,000 and 75,000.
It was a violent surge.
Yeah, it surged violently, peaking near 79,400 before establishing a new, higher baseline around 77,600. And to understand why that surge was so aggressive, we have to look at perpetual futures funding rates.
Right. And to explain that mechanism, a perpetual future is basically a derivative contract that lets you bet on the price of an asset without an expiration date.
Okay.
But to keep the price of that contract anchored to the actual real-world price of Bitcoin, the exchanges use a funding rate.
Right, it balances the scales.
Exactly. If too many people are betting the price will go up, they have to pay a fee to the people betting it will go down, and vice versa.
And according to the data, for 46 consecutive days, that funding rate was negative.
26 days.
Meaning the market was completely flooded with people betting the price would crash, the short sellers. There were so many of them that they were forced to pay a continuous daily premium to the long buyers just to keep their short positions open.
Yeah, it created a severely crowded short paradigm. The overwhelming majority of leveraged traders were anticipating a macroeconomic collapse, so they were leaning entirely on one side of the boat.
I picture it less like a boat and more like a massive game of musical chairs.
Okay, I like that.
But the chairs cost money, and everyone is circling the same single chair. When the music stopped, when the Fed uncertainty cleared, the price ticked up just slightly.
And that's all it took.
Right. That slight tick upward triggered automatic margin calls for the over-leveraged shorts. The exchange-matching engines ruthlessly closed their positions.
Because to close a short, you were forced to buy the asset back at the current market price.
Exactly. So all these forced buyers get dumped into the market at once, pushing the price higher, which triggers more liquidations, which forces more buying.
That cascade is a classic algorithmic short squeeze. Over $250 million in liquidations occurred across the market in a matter of hours.
Wow.
And it was heavily concentrated in those short positions. But, the short squeeze is really only half the story.
Right.
The foundation supporting that higher price floor isn't retail speculation. It is institutional accumulation.
Yeah, the spot Bitcoin ETF complex saw $996.4 million in inflows in just a single week.
Almost $1 billion.
BlackRock led the charge, but we also saw Morgan Stanley's new MSBT fund absorb over $100 million in its first 6 days, entirely overtaking the older Wisdom Tree fund.
The scale is shifting rapidly.
And corporate adoption is scaling to a degree that feels almost surreal, like Strategy Inc. utilized the geopolitical panic to deploy $2.54 billion, acquiring over 34,000 Bitcoin.
Yeah, they now hold 815,000 Bitcoin on their balance sheet.
Which is just a staggering amount of supply.
It represents a literal corporate supply shock because wealth managers and corporate treasuries do not buy assets the way retail traders do.
Right. They aren't just logging onto an app and hitting buy.
No, they use time-weighted average price, or TWEAP, algorithms.
TWEAP algorithms.
Yeah, these are automated programs that quietly and systematically purchase small amounts of the asset every few minutes or hours over weeks.
Oh, so they don't spook the market.
Exactly. They extract inventory straight out of the secondary market float without spiking the price. They're methodically pouring a concrete floor under the asset's valuation.
And companies aren't just hoarding the asset passively anymore either. DDC Enterprise holds over 2,300 Bitcoin, and they just launched a platform integrating AI models from OpenAI and Anthropic to actively manage their corporate treasury risk in real time.
That's a huge development.
Conversely, we saw the Ethereum Foundation sell 10,000 ETH to Bitmine Immersion Technologies via an over-the-counter block trade.
The financial engineering surrounding these assets is reaching legacy market levels of sophistication. We are tracking funds like Yield Boost and Tuttle Capital, utilizing 0DTE, which is 0 days to expiration covered calls.
Okay, let's unpack 0DTE for a second. How exactly are they turning Bitcoin's wild volatility into something a traditional pension fund would actually want to buy?
Well, by selling the volatility itself. A covered call is an option strategy where you hold the underlying asset like Bitcoin and sell someone else the right to buy it from you at a higher price later today.
Okay.
Because Bitcoin's price swings are so large, traders will pay a very high premium for that option.
So they just collect the fees.
Exactly. These funds sell those options every single day, collect the cash premiums, and distribute that fiat cash as a structured dividend yield. They're essentially converting network chaos into predictable quarterly cash flow.
It is brilliant engineering. But, this corporate accumulation relies entirely on secure, functioning infrastructure.
Yes, it does.
And as we cross-reference the geopolitical reports, this exact same infrastructure is becoming an active battleground for sovereign nations.
It really highlights the weaponization of fiat currency and the forced rise of alternative settlement networks. The situation in Iraq perfectly illustrates this dynamic.
Yeah, so the U.S. Treasury Department halted a $500 million physical cash delivery to Baghdad. We are talking about cargo planes filled with literal pallets of $100 bills.
Pallets of cash. Just stop.
They halted the shipments specifically to pressure the Iraqi government into dismantling proxy militias operating in the region.
But when a sovereign power deprives a regional economy of physical fiat currency, cross-border commerce, logistical operations, and daily trade do not simply pause.
Right, people still need to buy things.
Exactly. The economy adapts. Regional businesses and informal hawala networks were immediately forced to migrate their settlement architecture onto alternative ledgers.
Meaning they jumped onto Bitcoin and Tether just to keep their businesses running.
Exactly.
And at the exact same time, in the paralyzed Strait of Hormuz we discussed earlier, Greek intelligence firm Murisk identified a brand new maritime extortion scheme.
Right, the cyber syndicate.
Yeah, these cyber syndicates, which are linked to Iranian security services, are demanding safe passage fees from commercial ships. And they are demanding those fees be paid exclusively in Bitcoin or Tether.
They require cryptographic networks because those ledgers allow for non-reversible value transfer across hostile perimeters.
Meaning it can't be clawed back.
Exactly. A traditional bank wire can be intercepted or sanctioned. A decentralized transaction mathematically cannot.
But this brings us to the massive paradox I mentioned at the very beginning of the show.
Contradiction.
Yeah.
Yeah.
We have the U.S. Treasury using cash blockades, which forces adversaries to use crypto. But simultaneously, the U.S. Treasury recently collaborated with Tether to mathematically freeze $344 million linked to the Central Bank of Iran's illicit exchange networks.
It's a fascinating dynamic.
The U.S. is using crypto to freeze adversary assets while driving those same adversaries to use it. How does that contradiction actually function in practice?
Well, the contradiction dissolves when you dissect the underlying architecture of the specific networks being used.
Okay, break that down for me.
It demonstrates why different actors choose different tools in modern economic warfare. Stablecoins, like Tether, fundamentally represent a digital extension of the legacy banking system.
Because they're pegged to the dollar.
Right. They are backed by traditional U.S. Treasury bills and managed by centralized corporate entities. And because there is a central issuer, the U.S. Treasury can issue a legal mandate compelling them to execute a freeze.
But the base layer networks like Bitcoin don't have a corporate office you can subpoena.
Correct. Base layer networks operate strictly on decentralized mathematics. They offer true censorship resistance.
So no one is in charge.
Right. No government can call the CEO of Bitcoin to demand a wallet be frozen because there is no CEO and there is no administrative backdoor.
Wow.
This structural difference is exactly why we are seeing such an intense, aggressive regulatory response focused entirely on the centralized pieces of the ecosystem.
Right, like the Genius Act rulemakings that are rolling out, and they mandate that all stablecoin issuers maintain 100% reserve backing, specifically in short-term U.S. Treasuries.
Exactly.
Meanwhile, the executive branch is pushing for the Clarity Act, which aims to give the Commodity Futures Trading Commission exclusive jurisdiction over spot digital commodities.
They are aggressively corralling the controllable elements of the space.
Because the geopolitical vulnerabilities surrounding who controls the rails of global money are simply too great for nation-states to ignore.
Absolutely.
But, as we pivot from geopolitical vulnerabilities, the sources highlight a terrifying escalation in the deep technical vulnerabilities of the blockchain space itself.
Yeah, the on-chain shocks.
Right. While nations are fighting over who gets to regulate the network, cybercriminal syndicates are just breaking the architecture and taking the funds. The Kelp DAO exploit was a massive wake-up call this week.
Huge.
The Lazarus Group, which is a highly sophisticated cyber syndicate linked to North Korea, stole $290 million from this liquid restaking protocol.
And the mechanism they deployed bypassed traditional security entirely. They utilized a remote procedure call, or RPC, poisoning vector, routed through the Layer 0 infrastructure.
Okay, RPC poisoning sounds like incredibly dense computer science.
It is quite technical.
Let's translate that. Think of a smart contract, like an automated bank teller, and an RPC is the phone line the teller uses to check an account balance. The Lazarus Group essentially hacked the phone line and spoofed a fake caller ID.
That is a very accurate analogy. By manipulating the data the protocol was receiving over that line, the attackers tricked the system into generating unbacked RC tokens.
They printed fake collateral out of thin air.
Yes. And then they used those counterfeit tokens to drain legitimate wrapped Ethereum from the Aave lending protocol.
Unbelievable.
It completely shatters the risk-adjusted yield proposition of these highly complex, multi-layered smart contracts.
But as devastating as a $290 million smart contract exploit is, the research reports highlight something much deeper and exponentially more threatening: the quantum horizon.
This is the real architectural threat.
Post-quantum research firm Project 11 just awarded a 1 BTC prize to a researcher who successfully broke a 15-bit elliptic curve encryption key.
Right.
And they didn't use a billion-dollar supercomputer. They did it using 27 physical qubits on commercially accessible cloud quantum hardware.
Which represents a 512 times computational leap from the previous 6-bit record established just a few months ago.
It's moving so fast.
The hardware is accelerating significantly faster than the predictive models anticipated.
I need a reality check on this, though. Bitcoin uses 256-bit encryption. The gap between cracking a 15-bit key and a 256-bit key is astronomically vast.
It's a massive gap.
Right. The cryptographic models say it would require up to 500,000 physical qubits to crack Bitcoin's underlying algorithm. So, should we actually be sweating about quantum threats today, or is this just an interesting science experiment for a decade down the line?
No, it is a present-day architectural emergency, and it centers on a specific threat vector that security researchers call harvest and decrypt.
Harvest and decrypt, meaning they steal it now, read it later.
Precisely. Malicious actors, heavily funded by state sponsors, are vacuuming up and hoarding heavily encrypted data today.
Even though they can't break it yet.
Right. They know full well they cannot read the files right now. But they are storing the data with the explicit intention of holding it until quantum computers possess the qubit density to unlock it tomorrow.
So if your wallet keys, or a corporation's treasury data, or a nation-state's communications are intercepted on the network today, it doesn't actually matter that the mathematical lock holds today.
Not at all.
The adversary already has the safe in their living room. They are just waiting for the quantum drill to finish being built.
That is the grim reality. And this is no longer a future hypothetical, which is why the Ethereum Foundation is already heavily researching roadmaps to replace their current validator signature schemes with post-quantum hash-based signatures.
They have to move fast.
Yeah, the underlying mathematics of the entire global financial industry will have to migrate to stay ahead of the hardware.
It is incredible to step back and look at the sheer scope of the events we've unpacked today. I mean, we started with U.S. naval guns disabling a 5,000 container ship in the Gulf of Oman, paralyzing trade and spiking energy inflation.
Right.
And then we tracked how that $100 oil collided with a cooling labor market, putting massive pressure on Kevin Warsh and a Federal Reserve System trying to navigate unprecedented political blockades.
And then we observed how the digital asset market absorbed that macroeconomic chaos.
The short squeeze?
Exactly. Institutional wealth managers utilized automated algorithms to quietly extract billions in Bitcoin, ruthlessly punishing over-leveraged short sellers through derivative market liquidations.
And we watched artificial intelligence manage corporate treasuries, and quantum computers began chipping away at the cryptographic walls that secure the entire system.
It really is a lot to process.
It really feels like the lines between physical military power, central bank monetary policy, and decentralized mathematics haven't just blurred. They have completely dissolved.
They absolutely have.
A naval blockade, an interest rate decision, and a smart contract exploit are all reacting to each other in real time.
And that is the definitive new architecture of global finance. You cannot analyze a technical chart in New York without understanding the maritime insurance premiums in the Strait of Hormuz or the qubit count in a quantum research lab. Everything is inextricably linked by the flow of capital and data.
Which leaves us with a critical, entirely new question for you to mull over as you watch the markets moving forward. If quantum computing is truly on the verge of breaking current cryptographic locks, and artificial intelligence is already being trusted to actively manage billion-dollar corporate treasuries, how long until we see AI agents rewriting their own security protocols in real time to defend against quantum attacks?
That's the real question.
Are we about to watch non-human algorithms fight quantum wars over our financial ledgers, completely removing the human element from global financial security? Thank you for joining us for the week that was. Keep questioning the narratives behind the data, and we'll see you next time.